But are we seeing signs of a rally that wants to slow down and stall? Or are we just simply seeing some growing pains as we see this broadening?
I think we're seeing the consequence of elevated volatility. And it's been that way since the beginning of the year. You use the word momentum. Momentum is trying to find what will be the next trend establishing itself. Interestingly enough, it looks like Bitcoin and cryptocurrencies is where that next trend ultimately is going to be. Momentum remains entrenched in precious metals, gold, silver. That's not a recommendation to go buy them because I sold out of the GLD and I think they're extended. Small caps, the Russell, you still have momentum in place there as well, and some of the semis, and certainly energy and materials. But it's a type of volatility that's suggestive of capital not really leaving markets, but more reallocating to different places. And it feels a little bit uncomfortable because it's moving out of the familiar winners in 2025, the Mag 7, some of the financial names, and it's going to places like materials and energy where we were underallocated last year. So I think more than anything else, it's elevated volatility, and I think we all expected that.
Yeah, looking at the VIX right now, the VIX at almost 18, so a bit elevated from recent days. Not historically elevated, but certainly from recent days. Kerry, coming over to you as we kind of see these fits and starts in the market. We mentioned the markets have been pretty much flat over the last 2 months. You look at the Mag 7, they have been flat, down about fractionally 0.25% over that time. How do you view the fact that we're seeing those stocks that have really dominated the market flat over that time, but other areas like materials, industrials seem to be moving much higher?
Yeah, I think, Frank, what we're seeing in the market right now reminds us somewhat of what we saw in April, in that there's fear and there's concern, as we saw with tariffs. Right now, there's fear and concern when you hear the type of rhetoric from Washington about caps on oil prices, drug prices, credit card interest rates. What's going to happen with defense stocks, buying in their shares? Do tech companies have to give revenues or profit to the government for making a deal to sell chips in China, whatever? A lot of concern about profitability. A lot of concern we had about tariffs. It turned out that we sort of worked through the tariff situation and the market was up 18% last year. If you sort of figure out a way to play ball, the bark is worse than the bite. So it could be that we're having this, I would say, slight version of a panic. It's very small right now. It could expand, and that a month from now, 2 months from now, this is all past, and we're back on a road of recovery because earnings were good last year. Up 14%, earnings could be good again this year.
Yeah, for this quarter, the estimate's above 8.5%.
Yeah.
We've seen some weakness in recent days, but Shannon, coming over to you. I'm talking about LSEG. You're saying it's at 10?
The fourth quarter could be.
Okay, you're saying you're optimistic it's going to be over the estimate.
Yes.
Shannon, coming over to you. Are you worried about earnings? You're worried about profitability of these companies in Q4? Do you think that's what's weighing on investors' minds, or is it also that pending Supreme Court decision that many of us thought we might get today that could change the kind of picture when it comes to supply chain, inventory, and so many other things?
I want to take a big step back, actually, and look at the number of things that have happened over the last 2 weeks. And I think that if we went back a year ago today, we would see the market off significantly more than we're seeing it today. And I think because, number one, I think there is a bit of policy fatigue that's happening in terms of announcements from Washington, D.C. I think there are questions about the actual implementation and execution. There's no better example of that than tariffs. And so I think that what's happening from a policy perspective, there are questions about if these things can actually be implemented, and they likely will be diluted from sort of the top level narrative. Number two, I think that from an earnings perspective, the rotation outside of technology and utilities and, very AI specific trades to other areas of the market is based on an expectation of accelerating earnings growth in those other sectors. And so we're just at the front edge of that, however, right? A lot of that is baked into the second half of the year in terms of that year-over-year improvement in earnings. I think the most important piece for investors to look at right now is that this broadening trade is well beyond just adding small and mid caps to the mix or adding some of the sectors that Joe talked about that have underperformed. It's outside of the U.S. as well. It's emerging markets. And so I think that one of the things to really think about is that if you're not globally diversified today, you're not exposed to some of these more cyclical sectors, I think that's where you need to be focused on, because I think if you're waiting until March, April, May to wait for that acceleration of earnings growth in the second half of the year, some of that's going to be priced in already.
Steve, how are you seeing things? Again, markets at their session lows right now as we get big bank earnings, volatility ticking up a bit. Obviously, there's a lot of global issues going on, also some domestic issues, among them the investigation into Jay Powell.
Yeah, so there are so many different points to worry about in the market where I think there's reason for concern. So imagine yourself, here's the backdrop, imagine yourself in a rowboat, say, and there are 4 people. You're all standing, you all go to the right side of the boat, and it gets a little rocky, it gets a little unstable, and you're wondering, is it going to tip over, or is it going to right itself and smooth sailing? So I think we're on the right side of the boat. Everybody's bullish. So many are saying, and I'm not picking on them because they may be right, this is the best environment ever to invest. You've got an accommodative Fed, you've got renewed growth in the economy, and I'd say I'm not so sure. So what I see is that investors are finally waking up to the fact that Washington's not that helpful. They're essentially attacking capitalism by mandating or trying to mandate that oil companies invest in Venezuela, despite the profitability or the risk of those assets, is attacking capitalism. By the mini-me Trump going after home builders and saying, I don't want you to do buybacks, saying, I don't want you to do buybacks in defense. What's going to be next? What industry next? And then you take the war on every front where the administration came in on the promise that we're going to mind our own business, let others mind their own business. You've got Iran, which will drive oil prices up. You've got Venezuela. You've got who knows what, and the ongoing battle with China. So there's enough there to worry about. So the cross currents are that you've got yields which are down today, a flight to safety, but they really held steady because you don't know whether there's going to be increased inflation when you put a puppet in that's running the Fed, right? Or if it's going to be declining inflation still because of what we just saw in the numbers. So the bottom line for me is not putting any new money in the market. My positioning is the same as it's been. I'll keep it there, but I do think every day about raising more cash.
It's funny you say that. Goldman out with a note. First off, saying they're giving a nod to the increase in volatility. And Joe and everyone else, I want to bounce this off you. But since you hit us with the rowboat metaphor, he has a metaphor. There are times to go for the gas, there are times to go for the brake, and there are times to do neither. My instinct is the right judgment over the next few months is door number 3, which is to do neither. Do you see it that way? Is now the time to stand pat? And also, I'm not sure if that decline in yields was a flight to safety. We got 2 inflation reports that were better than expected as well. I mean, wouldn't that lead yields to go down as well?
No, it would. But my point is that over the last few months, because of the decision on the Fed, look, we know who every.
But you're saying door number 3. You're gonna hold.
Right. I'm holding steady. Now, also on the banks, we saw them sell off. That's not a reason for today. We see that every quarter.
Okay.
Right. And I wouldn't be surprised to see the market sell off even after a good quarter, which is expected, because we've seen that periodically. So look past those windows, and I'm at door number 3.
All right, Joe, you were nodding. Are you at door number 3 too? Just kind of standing pat, at least for the near term.
Volatility is hard. And it's a different environment. It's going to be a different environment than we've seen in 24 and 25. It just is. At the end of the year, I did do some selling. I haven't done very much in the market personally, other than I bought Merck, and yesterday I bought the OIH. So it's energy, it's healthcare. Traded some futures around, but I kind of agree with that. You're kind of right now a little bit on your heels looking for some tactical opportunities if ultimately you can find them. I said before, it looks in the near term like Bitcoin's probably developing into the strongest near-term trend. That's not my thing. I'm not a cryptocurrency trader or an investor, so I'm going to let that play out on its own, but I don't see very much in front of me right now that gets you excited about a tactical opportunity.